If you make $1 million a year and still do not have durable wealth, the problem is usually not income, it's leakage. That is the first principle of this course. Most affluent people are taught to focus on making more, scaling more, buying more, and investing more. But at a certain level, wealth is not built by production alone, it's built by retention. And retention is the tax structure and transfer problem. That is why millionaires still go broke after taxes. Not because they are poor earners, because they are inefficient retainers. Here is the mistake. They measure success by income. But wealthy families should measure success by retained capital. Income is what comes in. Retained capital is what stays under your control after taxes, spending, transaction friction, and transfer friction. So that's the game. And if you do not understand that, you can earn 7 figures for 10 or 20 years and still lose the wealth game. Because wealth does not disappear only through bad investment. They disappear through hidden drains that high earners ignore because cash flow is still strong enough to cover the damage. So in this video, I want to give you the framework we are going to use throughout this course. There are already 3 layers of wealth leakage, right? So layer 1 is operating leakage. This is the annual bleed. This includes already income taxes, state taxes, payroll taxes, net investment income tax exposure, poor entity design, bad compensation structure, inefficient distribution, trust compensation, unnecessary realized gains, and lifestyle growth that track income instead of net worth. This is the slow leak, right? It does not feel catastrophic because the client is still making money. But if you lose too much every year, compounding never gets the capital base that it needs. And this is where many affluent households fail. They think they have an investment problem. They really have is a retention problem. And then layer number 2 is transaction leakage. This is what happens when wealth is sold, refinanced, or retitled, gifted, distributed, or transferred without understanding the tax code embedded in the assets. This is where basis matters. And this is where certificate tax planning or general planning start separating itself from surface level planning. A lot of families think an asset went up in value, so that means they won. Not necessarily. If the asset is carrying low basis, suspended gain, depreciation exposure, or future recapture, the balance sheet may be overstating real after-tax wealth. The course material in this project make that point clearly, right? So for many families not exposed to federal estate tax, the planning focus has shifted away from poor transfer tax minimization and toward how appreciated assets are positioned. So capital gain tax can be avoided or mitigated when the assets are eventually sold. That is a huge shift, because many old strategies were designed to reduce transfer tax value, right? But reducing transfer tax value can also reduce basis step-up opportunity. So what used to look sophisticated can now work against the family if the estate is actually taxable. That same basic planning material makes the point differently. If the estate is under the exemption amount, you might prefer basis step up, and older discount-based planning might need to be reexamined. That is not an academic detail, right? That is real money, right? Because the wealthy do not lose only when they pay tax this year. They lose when they permanently give up future basis advantages, future liquidation options, and future compounding on capital that never needed to leave the family system. Layer 3 is transfer leakage, right? This is where family unintentionally destroy wealth between generations. Wrong title, wrong trust design, wrong beneficiary structure, wrong decision about when to give and when to hold, or wrong decision about whether to freeze value or preserve basis, wrong decision about whether an asset should sit in a taxable estate, outside a taxable estate, or inside a trust that creates income tax drag without enough offsetting benefit. This is why estate planning still matters, even for clients who are nowhere near estate tax threshold. We are very clear, right, in this course. One of the core planning issues is not just estate tax, but the difference between gifted assets with carryover basis under Section 1015 and inherited assets with dated debt basis adjustment under Section 1014. That one distinction alone can completely change the family real after tax outcome. So let me make this practical for you, right? Say if a client earns $1 million a year, but they overpay tax on operating income, they sell appreciated assets without planning around basis, they transfer assets during life that should have been held until death, they fragment ownership in ways that reduce future step-up, they fold gains into trusts that hit compressed tax bracket, and they fail to coordinate entity, trust, and estate strategy. Then high income is just covering structural inefficiency, right? It looks rich, it is not optimized. That is the difference between a high earner and a wealth builder. A high earner would just ask themselves, how much did I make, right? A wealth builder, on the other hand, asks for a better question. First, what is my real after tax retention rate? Not what is my gross income, not what is my book net worth, right? What percentage of economic gain actually remain inside my family system after tax and friction? Second, where is my future tax trap? Is it in low basis real estate, or in concentrated stock, or in business equity, or in assets sitting in the wrong trust? In an old planning structure designed for estate tax saving but harmful for income tax result? Third, which assets should I not give away yet? Because once you give low basis property, you might transfer built-in gain with it, right? So the basis planning material emphasize that planning now center on which assets more give the most benefit from basis step up, especially naming real estate with depreciation deduction and highly appreciated assets, right? That means not every gift is smart just because it reduces future estate. Sometimes the better move is to hold the assets, right? Preserve inclusion and capture a stronger basis adjustment. For is my current structure designed to minimize one tax or maximize the family wealth? Those are not always the same thing. This is one of the biggest planning mistakes affluent family make, right? They over focus on one line item, like one tax, 1 year, one transaction. But sophisticated planning is about system design. You want to look at the whole system, right? For example, if a married couple own appreciated property, title alone can change the after-tax result, right? The contrast between joint tenancy and community property, showing that community property can create a full basis adjustment for both halves on the first death, while joint tenancy might not. This is not just estate planning, right? That is balance sheet engineering. And that is exactly how wealthy families either keep or lose millions over time. The same is true with trust design. Trusts are often sold as protection vehicles, but they are not automatically efficient vehicles. And trust taxation material is really point out to you that capital gains can remain at the entity level. So D&I treatment matters, and then in an intervival trust funded before death might carry grantor basis if the assets were not included in the taxable estate. So again, the question is not, do I have a trust? The question is, what is this trust doing to my basis, my income tax exposure, my control, my creditor protection, and my transfer outcome? So this is the level this course needs to operate on. So let me give you the core strategic takeaway for this first lesson. Wealth is lost in 4 ways, right? You lose it when you earn inefficiently. You lose it when you own inefficiently. You lose it when you sell inefficiently. And then you lose it when you transfer inefficiently. That is it. And most millionaires who go broke after taxes are not failing in all 4 at once. Usually they're doing 1 or 2 of them badly for a very long time. That's enough, right? So what should a serious affluent client or advisor do differently? You want to start with the sequence. So step 1, you want to classify every major asset by tax character. What is low basis, what is high basis, what throw off ordinary income, what throw off capital gains, what has recapture risk, right? What have basis step up potential, what is better sold during life, and what is better held until death. Step 2 is to map ownership. Partially owned, jointly owned, community owned, inside a revocable trust, inside an irrevocable trust, inside a partnership, LLC, inside a structure built a year ago for tax environment that might no longer match today's reality. Step 3, identify the family biggest leak. Is it annual income tax drag? Is it trapped gain? Is it a transfer plan that destroys basis? Is it a trust structure that protects assets but tax them poorly? Is it fragmented ownership that makes sense under an estate tax mindset, but now erode future basis outcomes? Step 4, optimize for retained family wealth, not optics, right? Not the fanciest structure, not the most complicated estate binder, not the biggest gross income year, right? The best after tax, after transfer, after control outcome. That is the real strategy. So the point of this video is very simple. $1 million of income is not the goal. Retained capital is the goal. And retained capital comes from understanding that tax planning, trust planning, basis planning, tax asset protection, and transfer planning are not separate conversations. They are one conversation. This is what affluent clients need to hear, because once you see wealth through that lens, you stop asking, how do I make more? And you start asking better questions. What am I leaking? What am I carrying with hidden tax costs, right? What should I stop gifting? What should I hold? What should I retitle? What should I swap? What should I unwind? What should I preserve for basic adjustment? And what structure actually maximize what my family keeps? This is where this course begins, not with tactics, not with diagnosis, right? Because the family can diagnose leakage correctly, can usually fix it. And the family that cannot will keep mistaking income with wealth right up until the day they realize they built a very expensive illusion. In the next video, we're going to break down the actual wealth leakage map in more detail so you can start identifying where affluent families lose money first, second, and worst, right? So better the plan, better the system that you can start early, the better. If your advisor only talked to you in March and April, you do not have a tax strategy. You have a filing process. So let's get to the real issue, right? Most affluent clients are not losing wealth because nobody filed the return. They are losing wealth because the return is the only place the conversation happens. And once that is your model, you are already too late. So by the time you are reviewing a return, like the income was already earned, right? The gain was already triggered. The trust either distributed or retained earning or retained income. The gift either happened or it did not. The business was already owned in whatever structure it was owned in, and the low basic assets was either repositioned intelligently or left sit there without a plan. So the first mindset shift is this, right? Tax prep record records consequences. Well planning decides consequences. So this is not a small distinction, right? That is the entire game. And for client in the, if you have $2 million to like $25 million range of assets, this matter more than almost anything else, because this is the range where family often have enough complexity to need real planning, but not enough visibility to realize how much money is leaking through bad design, right? They usually have some combination of operating income, pass-through entities, appreciated real estate, taxable portfolio, retirement accounts, revocable trust, maybe one or two irrevocable trusts, and children or beneficiary who are not all equally ready to receive wealth outright. So on paper, they might look organized, but in reality, many of them are running a disconnected system. So maybe the CPA or tax pro prepared the return, the estate attorney drafted document years ago, the investment advisor managed assets, and no one is really coordinating the architecture here. So when nobody owns the architecture, right, the client gets compliant without strategy. So what the real strategy actually look like? So it starts by refusing to begin with the tax return. So certificate planning starts with the balance sheet, not income first, not forms first, form like the tax return, but you want to start with the balance sheet first. What do you own? How is each asset titled? What is the adjusted basis? What is the income character? What is the liability exposure? What is likely to be sold in the next year, 3 or 5 years? What should properly be held until death? What should be gifted during life? What belongs to a trust because control matters? And what should stay outside a trust because basis flexibility matters more? A lot of questions, right? So this is where good planning begins, because wealthy people like you do not just have income, right? You have embedded decisions. So every major asset is carrying out 4 issues at the same time: tax exposure, basic history, credit exposure, and transfer consequences. And if your advisor is only looking at the income tax result, they are missing 3/4 of the problems. Take a simple example here, right? Just say you own a business interest, 2 rental properties, a taxable brokerage account with appreciated stock, and a revocable trust. So the tax prep version of that you is pretty straightforward, right? So the CPA tax pro report the K1 income, like the rental activity, the dividend, maybe some capital gain, and file the return. The wealth planning version of that same you is completely different. So now the angle changed, right? So which of those assets are low basis and likely to create major capital gain? Which assets are exposed to operating risk? Which assets are best suited for lifetime transfer? Which assets should be intentionally held in a basis reset? So which assets belong to a structural design or spouse protection, or remarriage protection, or child governance? Which assets are producing taxable income in the wrong taxpayer? So that is a different level of thinking for you. So now let's go deeper, right? Because this is where the affluent you will pay attention. So the first practical difference between tax prep and wealth planning is basis planning. Most people think tax planning means fighting deductions. That is the entry level thinking. So real planning often means managing gains before the sale ever happen. Because once you reach this asset level, the bigger question is often not how to deduct another expense. It is whether you are about to trigger a 6-figure to 7-figure capital gains, because nobody builds a basis strategy around the assets. So here's the mistake that I see constantly. So family get fixated on estate reduction and start gifting appreciated asset without doing the basic math. But that only fine by the right case, but it's not automatically smart. Why, right? Because the gifted assets generally carry over the basis. An inherited assets generally get a new basis at debt called step-up, right? So those are fundamentally different outcomes. So if parents give away a very low basic property to a child during life just because they want to move wealth out, they might have sold one transfer question while creating a major future capital gain problem. So that does not mean gifting is wrong. It means asset selection matter. High growth assets are often different from low basis assets. So income producing assets are different from future appreciating assets, right? So assets likely to be sold soon are different from assets likely to be held long term. This is why a serious advisor should be helping you build the basis map, not some vague estimate, right? An actual basic map of the major holdings, like which assets are the family's candidate for lifetime transfer, which are better candidates for charitable transfer, which are candidates for a basis reset at death, which should be inside the taxable estate on purpose, because the income tax saving from a step-up basis might be worth more than removing future appreciation. So this is strategy, right? And none of that gets solved while signing a return in April. The second practical difference is trust income planning. So trust are where a lot of affluent clients think they are sophisticated when they are actually on autopilot. A trust is not a strategy. What a trust is, right? Let me tell you, a trust is a container. The strategy is in what the trust is supposed to accomplish and how the tax rules interact with that purpose. So if the trust is there for protection, then maybe you accept some tax inefficiency because protection is the goal. If the trust is there to shift wealth outside the estate, then appreciation matters. If the trust is there to benefit children but keep them from blowing through the money, then governance matters more, right? So if the trust is there for spouse access, then the surviving spouse right, control, tax exposure, and future estate inclusion all matter. And then you get to income taxation. Many affluent people like you have no idea that a trust can become tax inefficient very quickly if income is retained inside without a reason. So the real planning question is not, do we have a trust? The question is, should this trust distribute income this year or retain it? And that is not just a taxation question, it is a control question. Do you want income tax to the trust because you want to preserve control and accumulation? Do you want income carry out to the beneficiary because the individual tax result is better? Do you need to use the first 65 days of the following year strategically to clean up a distribution decision from a prior year? So those are fiduciary planning decisions. They are not compliant cleanup, right? And for affluent family with multiple trusts, the one large non-grantor trust with significant investment income, the issue is not just in theory, it is a recurring issue. The third difference is power planning. So this is where generic advice becomes dangerous. A lot of clients hear some version of this, right? If the exemption is high. So just file for portability and keep everything simple. Sometimes that is the right answer. Sometimes it is just being lazy, right? Portability is useful, but portability is not the same thing as planning. So portability can preserve the deceased spouse unused exclusion. It does not create creditor protection for the surviving spouse. It does not protect against remarriage problems. It does not lock in where the property goes at the second death. It does not automatically remove future appreciation from the surviving spouse estate. And it does not solve the basic trade-off inside the plan. This is why spouse planning for affluent families should never be reduced to outright business trust, right? The real question is what job the plan needs to do. Do you want maximum basis adjustment at the second death? Do you want asset protection during the survivor lifetime? Do you want the first spouse to control ultimate disposition, especially in a second marriage or blended family? Do you want appreciation excluded from the second estate? Do you want flexibility through disclaimer, planning, power appointment, or Q-tip style design, right? So this is where actual planning lives. This is a reason certificated planner still discuss bypass trust, disclaimer structure, and Q-tip planning even for families who might not owe federal estate tax immediately, because the decision is not just about federal estate tax. It's about balancing basis control protection and future growth. So an affluent client should hear that clearly. The wrong question is, do I still need estate planning if I am below the exemption? The right question is, what mix of spouse access, creditor protection, basis flexibility, and ultimate control produce the best family outcome? So this is not much more an intelligent conversation, right? The fourth difference is transfer design. This is where high-income families often make amateur moves with professional confidence, right? So they hear about the annual exclusion gifting, right, and start sending money or asset out every year because it sounds efficient. Again, that can be useful, but the move itself is not the strategy, right? The strategy is in what is transferred to whom, under what structure, and with what long-term purpose. So cash gifts are simple, right? Gifting discounted entity interest is not simple, or gifting low basis stock is not the same as gifting high growth private business equity. Gifting outright to a financially weak child is different from getting into a trust with a spendthrift protection. Gifting to one child who is married, exposed, or immature is different from gifting to a child who is financially stable and unlikely to create downstream risk. So real planning asks better questions. What are we trying to accomplish with this transfer? Either it's estate reduction, future appreciation outside the estate, liquidity support, or a home down payment, or a dynasty style structure. So protection from divorce or creditor issue that you are seeking with this transfer. And what is the tax character of the assets we are transferring, right? So if your advisor is not pairing transfer design with asset selection, then you do not have a wealth transfer strategy. You have a gifting habit. The fifth difference is entity architecture, right? So this matters enormously for the client range who are, for the wealth that you are accumulating here, right? Because many of these families have businesses, real estate, both, right? Tax prep see entity return, wealth planning see risk separation and income design. Like, should the operating company and the appreciating real estate be separated, or should they be together, right? Should management income live in a different place than hard assets? And should family-owned appreciating assets be centralized for governance or separate for protection? Should an entity interest be the asset that gets gifted instead of the underlying property itself? Should there be a review of whether the current structure will match how the family actually operates, or is the client just carrying the entity that was set up years ago and never rethought, right? So entity planning at this level is not about sounding complicated. It's about preventing a preventable collision, right, between taxes, lawsuit, and bad ownership design. And because those problems compound quietly, clients often do not notice until the damage, when there's a sale, a dispute, or a divorce, or a death, right? Then that is too late. So now let me tell you what wealthy people actually need from an advisor if they want planning instead of filing, right? They want at least a planning calendar, not a filing calendar, a planning calendar. So right after the return is filed, there should be a debrief, like what did the return review, what did the income land, what structure caused drag, which asset now need attention. And then mid-year, there should be a monitoring session. What is protected? Is there a sale likely? Are gift going out? Are trust distribution being considered? Is charitable planning on the table? Should low basis assets be held or moved? Does spouse planning need to be revisited? Or these opportunities to redesign before the year locks, right? Before year end, there should be an execution meeting, not a broad like conversation, right? Execution. Gift completed, trust decision made, asset location review, charitable transfer funded, entity cleanup done, basis sanity assets review one more time. So this is how affluent family actually preserve wealth, not by asking for a big refund, not by waiting for April, right? Not by confusing accurate reporting with intelligent design, right? So if you want one standard for this entire video, it is this, right? A tax return tell you what the last 12 months produced. A wealth planning tell you what the next 12 months should produce. And if the same person is doing both jobs, that is fine, but only if they are actually doing both jobs, because many professionals are excellent at compliance and weak at architecture. And architecture is what wealthy families are really paying for, right? Whether they realize it or not. If your advisor is not looking at your balance sheets, your basis, your spouse plan, your trust, your transfer design, and your entity architecture as one integrated system, then your planning is fragmented. And fragmented design is exactly how affluent families end up with clean return, good intentions, and disappointing long-term outcome, right? So this is why tax prep is not wealth planning. Tax prep closes the file. Wealth planning changes the family future before the file is ever created. So in the next video, we're going to make this even more concrete by identifying the exact places where wealth leaks inside high-income household, because once you understand that the real problem is design, the leaks become much easier to spot. In the last video, we established the core idea that high income does not equal durable wealth. So this video goes one level deeper, because I want to show you where affluent real estate heavy households actually lose money year after year, even when they think they are doing well. The real danger is not usually one catastrophic mistake, but it's 7 silent leaks that compound quietly in the background, right? So they usually do not show up on a tax return. They are rarely modeled in one place. CPA or tax pro might reduce current year tax. An attorney might draft the trust, and an investment advisor may manage market exposure. A property manager might oversee operation, but affluent families lose wealth in the hands-up point between those silos. That is the point of this video. If you own real estate, operating entities, brokerage assets, and family wealth vehicles, your problem is not simply tax minimization. Your problem is wealth retention across time, across entities, across family members, and across generations. So let's walk through the 7 silent leaks, right? So the first leak is the annual tax leak from treating tax as a filing event instead of a capital retention system, right? Many wealthy households think they are tax efficient because they have deductions, depreciation, and a good preparer. But the real question is not whether you saved tax this year. The real question is whether your structure is preserving after-tax capital over 10 or 20 years period. In real estate heavy household, right, this leak often starts with a fragmented tax strategy, right? One entity is optimized, but the household is not. Rental activity is handled one way, operating income is handled another way, and then passive losses are trapped. And then state taxes are paid in the least efficient location. Interest limitation, entity choice, compensation design, depreciation timing, charitable planning, and trust taxation are considered separately and set up as one integrated model. What happens, right? This creates drag, right? So a client might look at tax smart on paper, but still be bleeding retained capital because nobody modeled the cumulative effect of RA income tax, state tax, trust tax bracket, capital gain exposure, and future recapture. So this is where certificate planning begins to matter, right? You do not just ask what is deductible. You ask where should the income live, who should report it, when should it be recognized, and what kind of income is it? What basis consequences are being created, and what does that do to family capital 5 years from now? That is a very different question, right? The second leak is depreciation without exit planning. Real estate owners love deduction on the way in, but many of them do not properly model the way out. Accelerated depreciation feels like a win because it reduces current taxable income. So often it is a win, but if you do not pair it with a sales strategy or entity strategy, basis strategy, and transfer strategy, you may simply be borrowing from your future at a very expensive rate. So this is especially dangerous when clients celebrate paper losses while building a future recapture problem that they do not understand. So they think in terms of annual tax savings, right? The better question is whether the depreciation is being converted into permanent tax benefit, deferred tax benefit, or future tax concentration. If the only plan is to take the deduction now and figure out the sale later, that is not wealth preservation. That is a tax deferral with no map. The third leak is basis leakage. So this is one of the biggest leaks in affluent family, and it is badly under-discussed. A lot of older planning was designed to put appreciation out of the estate. That makes sense when estate tax exposure was the dominant issue. But for many families today, especially those below the transfer tax threshold, the bigger issue is not federal estate tax, it's capital gain exposure from low basic assets. So that changes the entire conversation now, right? So if you transfer appreciating property during life, the donee usually tax carry over basis. So if the same property is held until death and included in the gross estate, the assets generally receive a basic adjustment to fair market value at death. So that difference can be massive, right? So the leak is this, right? Family give away low basic property too early, like title, property poorly, fragment ownership for all valuation accounts reason, or use trust structure without underwriting the basis consequences. So they say one kind of tax, one thing they do, why they basically quietly magnifying the other. So this is where often planning become more nuanced, right? So sometimes the right move is gifting, sometimes the right move is inclusion, sometimes the right move is swap power, right, by a grantor trust. So low basis assets can be brought back to the taxable estate for a basis adjustment while preserving other transfer tax benefit. Sometimes the right answer is to use marital or Q-tip design because the second basis adjustment matter more than keeping all appreciation outside the surviving spouse estate. So that is what certificate family miss when their planning is still running around own assumptions. The fourth leak is balance sheet leakage from bad title, bad asset location, and bad liability containment. So this leak does not show up fast on a tax return, but it shows up when something goes wrong, right? Real estate heavy households often accumulate assets faster than they redesign ownership. Like they have rentals in personal name, liquidity in the wrong entity, cross-collateralized debt, outdated LLC structures, operating risk sitting next to long-term family assets, and beneficiary destinations that do not match their estate plan. They may look wealthy, but their balance sheet is porous. So if a liability hits the wrong pocket, or a creditor reach an asset that should have been isolated, right? The wealth destruction is not just in theory, right? It is immediate. It's right now. You're gonna feel the pain, and the same is true in divorce, incapacity, probate, elder care, and business disputes. So trust and entity structure are not just about tax, right? They are also about who controls the asset, who can reach the assets, and whether a family will survive disruption. So a household that owns $10 million property this week with weak compartmentalization is often less secure than a household with half of that wealth and with a better structure. This is why serious planning looks at the household balance sheet the way a family office would. So not just what asset exists, but where they sit, what risks attached to them, and whether the risk can jump lanes. The fifth leak is family leakage through outright ownership. So this is where family confuse transfer with preservation. So parents often think they're helping by adding a child to title, making early gifts, paying into account informally, or transferring assets outright to avoid probate or keep things simple, right? But simplicity on the front end can produce major leakage on the back end. So when assets move outright, they might become exposed to the recipient's creditors, divorce, bad judgment, bad spending, addiction, lawsuit, or family politics. They may also lose planning flexibility. And in the many cases, the transfer creates a carryover basis problem that would not have existed if the asset had been held and transferred at debt or passed under a better trust design. So wealthy families should learn to distinguish access from ownership. A beneficiary does not need to own principal outright to benefit from the principal. A well-designed trust can allow health, education, maintenance, and support distinctions. Investment management, incentive provision, character protection, and family governance while preserving the assets from unnecessary exposure. So that is a very different outcome than writing a large check and hoping maturity catches up, right? The sixth leak is transfer tax and reporting leakage from incomplete execution. So high-end families do not usually fail because they have never heard of gifting or trust. They fail because implementation is sloppy. So valuation are weak, disclosure is incomplete, gift tax returns are not filed when they should be, formula language is imprecise, like crummy notices are not administered properly. The transfer documents say one thing, the accounting records say another, and the tax reporting say something else entirely. So this is not just administrative sloppiness, right? This is financial leakage. So poor reporting can keep statutes open and weaken evaluation position, also waste your exemption, and also turn what should have been a clean transfer into a future controversy. In certificated planning, paperwork is not just clerical, right? This is part of the asset protection and tax defense architecture. So this matter even more with closely held entity like trust transfer, split gifts, generation skipping planning, and family business interests. So when the documentation is weak, the family effectively self-insuring against avoidable tax and legal risk. The 7th leak that I want to talk to you today is governance leakage, right? So this is one of the one almost that nobody gonna model. So a wealthy family can have good tax planning and still destroy wealth because nobody has the defined decision right. Like who can sell, who can borrow, who can control distribution, who can amend, who can become trustees. So what happens if one spouse dies, remarries, or becomes incapacitated, or disagrees with children from a prior relationship? So what happens when a passive asset becomes an active management burden, right? So what happens if one heir wants income and another wants long-term appreciation? If those answers are not built into the structure, wealth start leaking through, like conflict, delay, forced sale, and court involvement, right? This is why estate planning is still alive, even for clients who may never pay federal estate tax. So the planning is not only about transfer tax, it is about control, continuity, incapacity, credit insulation, basis management, and preserving family capital through messiness of real life, right? So now let me tie these 7 leaks together because this is where premium planning really begins. Like annual tax leakage asks whether the household is retaining enough after tax cash and avoiding unnecessary drag. Depreciation and basis leakage asks whether a today tax saving are creating tomorrow exit problem or not. The balance sheet leakage asks whether the assets are sitting in the right legal containers. And then family leakage asks whether ownership is being transferred intelligently or simply just handed over with no thought, right? Reporting leakage asks whether the plan is defensible or not. Governance leakage asks whether the plan can survive real people, real marriages, real debt, and real conflicts in real life. And here is the uncomfortable truth, right? Most affluent families do not have one master plan that solves at the same time. They have fragments, right? They have a trust here, an LLC there, a few gifts, a life insurance policy, maybe a living trust, maybe an estate attorney, maybe a CPA who is strong on compliance, but no integrated architecture. This is why they leak wealth. The household that preserve the wealth do not do something different. They stop thinking in isolated transaction and start thinking in systems. They model not just income but ownership, not just deduction but basis, not just gifting but control, not just assets growth but assets survivability. And when you do that, you stop asking, how do I save tax this year? You start asking, how do I keep the capital inside the family, inside protected structure with optionality, with basis efficiency, and with the least friction possible over decades. So this is a big mindset shift, right, for anybody. So for real estate heavy household, so premium planning it usually means deciding which assets should be consumed, which should be harvested, which should be gifted, and which should be included for basis adjustment, which should sit in protective trust, which should remain accessible, and which should be ring-fenced from the family or operating risk. So this is not generic estate planning, right? This is wealth engineering. And this is why affluent clients will pay for premium planning when they understand the alternative, right? The alternative is not doing nothing. The alternative is continuing to leak. So in the next video, we move from diagnosis into architecture. We're going to take the leaks and turn them into planning framework, so you can see how high-end household actually design a system that hold wealth and start merely. The wealthy do not treat tax, legal, and family planning as separate projects. They build a flywheel, right? If you are in the $2 million to $25 million net worth range, your biggest risk is not lack of income. It is fragmentation. You have income coming from different sources, like assets sitting in different places, documents that was created at different time, and advisor working in parallel instead of in sequence. And that fragmentation creates drag. So this video gives you the operating system for everything we are going to do in this course, right? Every serious wealth plan run through 4 stages, right? Earn, protect, compound, transfer. So it's not separate idea, it's a continuous loop. And when you see it this way, you stop chasing tactics and start building a system. So let's start with earn. So at this level, earning is not about working harder, it's about controlling how income is created, where it lands, and what tax profile it carries, right? $1 million of W-2 wage income is not the same as $1 million of pass-through income. It is not the same as rental income, it's not the same as unrealized appreciation. So each one behaves differently, each one creates different planning opportunities. Each one either accelerate or slow down your ability to build long-term wealth. So the first step is this, right? You do not just track income, you map income. Where is it generated? Which income producing? Which entity producing it? What type of income is it? Who is taxed on it? What can be retained versus what must be distributed? Because if income showed up in the wrong place, everything downstream become harder, right? You might still make money, but you lose flexibility. You lose control over timing. You lose opportunity to reposition assets. You create unnecessary tax drag that compound over time. For example, business generates strong cash flow, but everything flows directly into personal income without through structure. You are effectively forcing the income through the highest friction channel every year. So if real estate is generating depreciation benefit in one entity but appreciation in building somewhere else without coordination, you might show short-term tax problem while creating long-term transfer problem. So owning is not just about how much you make, it's about how cleanly your income feeds into the rest of the system. Now once wealth is earned, the next stage is protect. And this is where most affluent families think they are stronger than they actually are, right? Because protection is not just insurance, protection is ownership. If you do not control how everything is owned, you do not control what happened to it under stress. So the question is not do you have an LLC or a trust. The question is whether your ownership structure actually matches your risk. What is how personally, what is how an entity, what is how an trust, and do those layers actually separate exposure, or are they just labeled on paper? So a lot of families have a revocable trust, but their key assets are not aligned with it, right? They have LLC, but there is no real separation of liability or coordination with their estate plan. They have documents, but not a system. And that matters, right? Because risk does not show up when things are going well. It showed up when something breaks. A lawsuit, a divorce, a business dispute, a sudden death, or even just a liquidity event that was not planned for. So protection is what keeps the system intact when pressure hit. And here's the connection that most people miss, right? Protection is not just about avoiding loss. It's about preserving continuity, right? Because without continuity, compounding does not happen. That brings us to the third stage, compound, right? So compounding is not just about investment return. It's about how long capital can stay inside a stable system without unnecessary interruption. If capital is constantly being taxed inefficiently, distributed without strategy, exposed to risk, or forced into reactive decisions, compounding slow down or break entirely. So families do not just ask where should we invest, they should ask where should each asset live, because not all assets are equal, right? So a low basis, high appreciated property are not the same as newly acquired assets. A concentrated business interest is not the same as diversified portfolio. So assets inside retirement account are not the same as assets held personally or in trust. So each one carries different tax distribution, different risk profile, different transfer implications. And this is where compounding becomes a structural decision, not just an investment decision. So some assets are better held personally because of future basis consideration. Some assets are better moved into long-term structure because future appreciation matter more than the current basis. Some assets should be positioned to allow flexibility at debt. Others should be positioned to grow outside the estate entirely. If you treat all assets the same, you are leaving a lot of value on the table. The family that compound well are not necessarily the one who earn the most. They are the one who reduce friction every year. Less unnecessary tax, less forced distribution, less exposure, less disruption. And this is what allows capital to actually multiply over time. Now the final stage is transfer. Right? This is where most planning is either too late or too rigid. So transfer is not something that happens as debt. It is something that designed during life. Why? Right? Because every asset, already has a future outcome. Right? The only question is whether that outcome is intentional or accidental. So who controls it after you are gone? How it taxed when it change hands? Does it receive a basis adjustment or carry over its existing basis? Does it pass cleanly or does it create fiction for the next generation? So the answers are not decided at debt, they are baked in long before. So this is why sophisticated families think about transfer early, even if they are not subject to estate tax. Because the goal is not to reduce estate tax, the goal is to control the result. So sometimes that means holding certain assets until death because the basic reset is more valuable than gifting them early. Sometimes it means shifting future appreciation out of the estate while retaining control. Sometimes it means building flexibility into trust structure so decision can be made later when more information is available. Transfer planning is not about moving everything out. It's about deciding what should move, what should stay, and under what condition, right? And most importantly, it is about preserving optionality. So now let's tie it together with a simple comparison. So one family owns wealth, owns real estate, has a business, and has some basic estate documents, but their planning is reactive. Their CPA focusing on the return, their attorney focusing on documents, their investment decisions are separate from both. There is no unified review. So income flow wherever it happened to land. Assets are titled based on convenience. Trust exists but are not fully integrated. So no one is tracking basis across assets. No one is thinking about which assets should be held or moved. And transfer planning is something they assume will be handled later. So on paper, everything looks fine. Underneath, there is friction everywhere. Another family with similar wealth run a system. So every year they review how income is being earned and whether it's landing in the right place. They review ownership and tiling to make sure assets are properly separated and aligned. They review the asset base to understand where appreciation is building and where basis matters. And they review transfer strategy to decide what should move, what should stay, and how much flexibility they need going forward. So they are not doing more work, they are doing coordinated work. And because of that, each year builds on the last. So this is the flywheel. Earn efficiently so income feeds the system correctly. Protect intentionally so the system stays intact. Compile with awareness so capital actually grow. Transfer strategically so wealth survive the transition. So every module in this course fits into one of the 4 stages. And from this point forward, we are going to go deeper into each one, not as isolated tactic, but as coordinated decision inside the system. So in the next video, we're going to start with the first stage and break down how high-income family on in the wrong structure, why that mistake create hidden tax drag, and how to begin fixing it before everything else is built on top of that. You can spend a significant amount of money on trust, attorney, and advisor and still feel completely fair, right? Not because your strategy was wrong, but because your asset were never titled correctly. This is one of the most expensive blind spots I have seen with high income and high net worth clients. They believe they have a plan, but what they actually have is a set of documents that were never fully implemented. And in wealth preservation, implementation is everything, because the system does not follow your intent. It follows legal ownership and contractual instructions. So that means titling and beneficiary designation are not administrative detail, right? They are the plan. If those are wrong, everything else is just theory. So let's start with the first principle. Titling controls what happened in real life. When someone passes away, assets don't move based on what you meant to do. They move based on how they were legally owned. If an asset is in your individual name, it goes through probate unless something overrides it, right? If it is jointly owned with right of survivorship, it transfers automatically to the other owner. If it is titled in a trust, the trust controls it. If it has a beneficiary designation, that designation controls it. The last point is where most certificated plans break, because beneficiary designation operate under contract law, and contract law overrides your will. It overrides your trust. If your IRA say it go to your sibling, but your trust say everything go to your children, then the IRA go to your sibling. No court's gonna fix that, right? No intention override that. This is how the system works. And for affluent clients, this is where the majority of wealth actually sit: in retirement accounts, in brokerage account, in life insurance. So those are not, if they were not coordinated, right, your plan is really fragmented. So let's go one level deeper. Different assets require different titling strategies. And this is where generic advice completely falls apart. You cannot apply one approach across real estate, brokerage account, retirement assets, and business interests, right? Each one has different tax consequences, transfer rules, and risks. Let's start with real estate, our most favorite assets, right? Most clients assume that putting real estate into a trust is always the right move. Sometimes it is. But the real question is why you are doing it. If the goal is probate avoidance, then yes, a revocable trust or transfer on that structure can simplify administration. But that alone does not address tax efficiency. For a high value real estate with low basis, and more important question is whether that asset should remain in a taxable estate to receive a step up in basis debt, because that step up can eliminate decades of building capital gain. So now you have trade-off, right? Do you prioritize administrative simplicity, or do you prioritize long-term tax efficiency? Certificated planning with both. So now look at brokerage accounts. These are often scattered, right? So one account maybe in a trust, maybe 2 accounts in individual names, another account with a transfer on death designation, right? This creates inconsistency, right? And inconsistency creates risk, because now different assets follow different rules at death. Some go through the trust, some bypass it, right? Some go directly to the named individuals. That means your distribution plan is no longer controlled in one place. And this is where family run into unequal distribution timing issues, and avoidable tax consequences. So now let's talk about retirement account. This is where I see the most costly mistake, right? Because retirement accounts are not just estate planning tool, right? They are income tax vehicle, and the beneficiary designation determines how that tax unfolds. If you name an individual, that person inherits the accounts and is generally subject to distribution rules that force the account to be empty within a defined period. That accelerated income tax. If you name a trust, you might gain control, but you also introduce another layer of complexity, right? Because trusts are taxed under a compressed bracket, which means income retained in the trust can reach the highest tax rate very quickly. So now the decision is not just who gets the asset, this is how and when that asset will be taxed over time. So this is very different level of thinking. So now let's connect this to business interests. If you own an LLC or S corporation, the ownership structure matters just as much as the operating agreement. Is the interest owned individually? Is it owned by a trust? Does the agreement allow transfer of debt? Are there restrictions, buy-sell provisions, or valuation mechanisms that override your estate plan? Because in many cases, the governing document of the business control what happens, not your will, not your trust, right? So if those are not aligned, you can have a perfectly drafted estate plan that is functionally irrelevant when it comes to your largest assets. So now let's take a step back, right, and talk about what is really happening here, right? Funding matters more than drafting. A trust is not just funded, does not control anything. It is just a document, right? Somebody drafted document. And this is where affluent clients often stop too early, right? They set up the structure, but they do not complete the transfer process. They do not retitle assets, right? They do not update beneficiary designation. They do not coordinate new accounts as they are open. So over time, the plan drips. And by the time something happens, the actual ownership structure looks nothing like the intended design. Now let's go one level higher, right? This is where critical difference between probate avoidance and tax optimization, and most people confuse the two. Avoiding probate is about efficiency, right? It's about speed, privacy, and administrative simplicity. But avoiding probate does not mean you have optimized taxes. In fact, some of the most common probate avoidance strategies create new risk. For example, adding a child as a joint owner to avoid probate might create unintended gift tax exposure. It may expose the assets to that child's creditor, right? And it may complicate basic treatment. So the goal is not just to avoid probate. The goal is to transfer wealth in a way that preserves control, minimizing tax erosion, and align with your long-term plan. Excuse me. And that requires coordination. Now let me give you a real-world scenario what that would happen, right? Often than what it should. So a couple set up a revocable trust, right? They feel like they are done, but they never transfer their primary residence into the trust. They leave their brokerage account and individual name, and their retirement account still lists outdated beneficiaries. So on paper, they have a complete estate plan. In reality, most of their wealth sits outside of it. So when the first spouse passes away, the house goes through probate. The brokerage account transfer based on the account tiling, not the trust, right? The retirement accounts follow directly to a named beneficiary, potentially creating uneven distribution and accelerated tax. So the family is dealing with administrative complexity, tax inefficiency, and misaligned outcome. And none of that came from bad strategy, right? It came from incomplete execution. This is why asset administration consistently reinforces that will, trust, and beneficiary designation must be coordinated as a system, not treated as a separate documents. So now let's go even deeper into how certificated planner approach this, right? They treat titling as an ongoing discipline, not a one-time checklist. Every time a new asset is acquired, they ask, where should this sit? Should it be inside the trust for control and coordination? Should it remain outside for basic optimization? Should it have a direct beneficiary or simplify transfer? Or should it be structured to protect against creditor or family risk? And this is where high-level strategies start to show up, right? Because the answer is not the same for every asset. Some assets you intentionally keep inside the taxable estate to capture a basis step up. Some assets you move out early because future appreciation is the real tax risk. Some assets you structure for control even if it creates tax trade-off. This is real planning, right? It's not just having a bunch of documents, right? Not just having tax preparation done, but deliberate positioning of asset across your balance sheet. So here is the shift that I want you to make. Stop thinking of titling as paperwork, right? Start thinking of it as a control architecture, because titling determines who owns your wealth, who receives it, how fast it's moved, and how much tax is paid when it does. If you get this wrong, even a great plan failed in the background without you knowing it, right? If you get this right, your plan actually works. And if your wealth grows, this becomes even more important, because when your assets grow, your income grow, it's great. The complexity increases, right? So more account, more entity, more moving parts, which means more opportunity are misaligned. So the discipline is simple, not just easy. You need regular reviews. You need coordination across every asset class, and you need to treat titling and beneficiary designation as core planning decisions, not just administrative afterthoughts. Because in the end, your wealth does not transfer based on what you plan. It transfers based on what you title. In the next video, we're going to go deeper into what actually happened when someone passes away. Because once you understand how the estate administration process really works, you will start designing your plan in a completely different way. If your operating business, your rental, and your personal assets are all tangled together, your wealth plan is already weak. Not because you made a bad decision, but because success usually outpaces structure. Income grows, properties accumulated, entity gets formed along the way, and what you ended up with is not a system, it's a collection. And at the $2 million to $25 million assets, this is where most people plateau, right? Not because they stop earning, but because their structure stopped them from scaling intentionally. So what are we going to do this video is build the architecture the right way. Not just entity, not just tax election, a coordinated system that separates risk, preserve flexibility, and prepare your wealth to transfer. Because the structure is not paperwork, right? The structure is the strategy. The first principle is simple, but almost always violated. Your operating business and your investment assets should never live in the same risk environment. Your operating company is where volatility lives, right? Contracts, employees, liability, execution risk. That entity exists to generate income. It is not designed to store wealth. Your real estate, on the other hand, is where wealth accumulates. It is equity, appreciation, leverage, and long-term positioning. If those two live in the same place, you are effectively running your entire balance sheet through your high-risk environment. This is not strategy, this is exposure. So the first move is separation. Your operating entity is one silo, your real estate is another, right? Clean break, no cross-contamination. So here is where most advisors stop and where we would want to go deeper, right? Legal separation alone is not enough. You also need to understand the difference between how something is taxed and how something is protected. A single member LLC can be ignored for tax purposes but still critical for liability. An entity can protect its assets legally but create problems when you refinance, sell, or transfer. So high-level planning is don't align is about aligning those two systems, right? Not confusing them. Because at this level, the real risk is not just lawsuit, it is structural inefficiency over time. It is getting stuck with asset in the wrong place when you need to move them. So now let's talk about real estate specifically, right? So most investors think in terms of number of properties, like number of doors, how many doors do I have, right? Sophisticated investors think in terms of category of risk on top of that. So some properties are stable, long-term, low touch. Some are operational heavy. Some are high equity concentration. Some have higher liability exposure. And the biggest mistake I see is grouping properties based on the convenience instead of risk. So putting 4 or 5 properties into one LLC because it is easier is not a strategy. It is a decision to let the property share exposure. So the right question is not how many LLC should I have. The right question is which asset can I afford to have tied together if something goes wrong. That question forces clarity, right? Because if one's property get hit with a major claim, anything sitting next to it in the same structure is exponentially exposed. So higher value assets, higher risk assets, and operationally intensive properties often deserve stronger isolation. Lower risk property may be grounded strategically, but only if you understand the trade-off. That is the difference between intentional structure and accidental structure. So now let's step into more advanced layer that most high-income owners miss. Not all entities are equal for holding appreciating assets. A very common mistake is extending an S corporation mindset into real estate. An S corp can be powerful as an operating business, but it is often a poor long-term home for appreciating real estate, because once that property appreciate inside an S corp, right, your flexibility shrinks. Distribution of appreciated property can trigger gain. You cannot easily reposition ownership. You limit liability to bring in partners or restructure cleanly. So while the S corp may be your income engine, your real estate usually belongs in a more flexible holding structure. This is why experienced planners separating operating income from appreciating asset even when the same family control both. Now let's go into a level higher, right? At a certain point, this is not just about entity, it's about ownership layers, right? So you have to decide where control sits, where income flow, and where appreciation accumulates. Personal ownership is simple, but what does it create for you? It creates exposure, right? It limits transfer planning, it concentrates everything in your name. Entity ownership creates structure, but by itself it does not solve long-term transfer or estate issues. So this is where trust come into play, right? But not in the way that most people think. Revocable trust is useful for administration and continuity, but it is not an asset protection strategy, and it does not create tax magic by itself. So if your entire plan is everything go into my living trust, you have not built architecture, you have built organization. So the real question is which assets, or more specifically, which ownership interest should eventually move into more advanced structures designed for transfer. Because at this level, your real tax issue is not just income, it is the embedded gain, like the accumulated gain. So it is the appreciation that's sitting inside your properties. This is the depreciation you have taken. It is the difference between your basis and the current value, right? And then this is where structure becomes strategic. So asset held until debt can receive a basic adjustment to fair market value. That reset can eliminate decades of building gain. But not every structure preserves that outcome equally, right? Some planning strategy improve control or creditor protection, but reduce flexibility around basic planning. So now you are making trade-offs, right? Not between good and bad, but between different types of advantages. So this is where high-level planning actually lives. So now let's apply this to a real example, right? Let's say you have an S corporation generating strong income with 8 rental property all held in your personal name. On paper, everything looks fine, right? The return file, the income is reported, but structurally it is weak. Every property is tied to you personally, right? A problem at one property can reach your entire balance sheet, right? So your business income flow into the same personal layer that hold all your investment. So there is no separation between risk generation and wealth storage. So this is no clear ownership structure for future transfer, no ability to carve out interest, no strategy for gradually moving wealth. And every year that passes, right, more appreciation builds inside that structure, making it harder to change later. So what does this ideal structure start to look like, right? Your S corporation remain a clean operating entity. It generates income, but it does not accumulate excess wealth unnecessarily, right? Your property are reviewed and separated or grounded intentionally based on risk, value, and function. So each property or group sitting its own LLC where appropriate. When ownership of the LLC is structured deliberately, right? Some may remain directly owned for flexibility, others might sit under a holding entity or trust structure to prepare for transfer and coordination. Now you are not just holding assets, you are organizing them, right? Then you step back and map the entire system, right? Which assets are meant to be held long-term for basic setup? Which assets are candidates for sale or repositioning? Which assets may be partially gifted over time? Which assets should remain centralized for management but flexible for ownership? When you see it that way, your structure start being reactive and become intentional. And here's the part that most people miss, right? The goal is not maximum complexity. The goal is maximum clarity. So every entity should have a job. Every layer should solve a problem, right? So if your entity exists and you cannot clearly explain why, it probably should not be there, right? Because unnecessary complexity creates friction, and friction leads to mistakes like misfiling, poor bookkeeping, broken strategy, right? The right structures feel simple when you look at it, even though it is strategically deep underneath, right? So here is how you evaluate your own situation. If your operating risk isolated from your assets, or your property is structured based on actual risk, not convenient, right? Do you understand the difference between tax treatment and legal protection? And is your ownership structure designed for future transfer, not just current ease? If the answer to any of those is no, you do not have a completed structure yet. What you have is you have a starting point, so you can explore further. And this is exactly where most high income earners are at this point. In the next video, we're going to go even deeper into one of the most important decisions inside this framework, where real estate should actually be held from a tax and planning perspective, and how that decision affects depreciation, liability, refinancing, and your long-term exit strategy. Because once the architecture is built, the next step is optimization. The biggest difference between mass market advice and high-level advice is coordination, right? So that is the real dividing line. For most people at this level already have a CPA, an estate attorney, maybe a financial advisor, maybe insurance. The issue is not access to professional. The issue is that none of those professionals are responsible for how their decisions interact with each other, right? And this is where wealth leaks. So at the $2 million to $25 million level assets, your risk is not that someone forget to file the return or draft a document. Your risk is that everything gets done correctly in isolation and incorrectly as a system. So a premium wealth strategy team exists to solve that exact problem. So no single advisor solves everything, right? The estate attorney is responsible for legal structure. They design the trust, define control, determine how assets flow, and create the rules around distribution, protection, and succession. So that work is critical. But legal drafting alone does not produce a tax efficient or operationally sound outcome, because the trust only works if it is funded. And this is one of the most common failures in high net worth planning. The documents are drafted, but the real estate is never retitled. The brokerage accounts are never aligned. The LLC interests are not transferred, and the beneficiary designation are inconsistent. So on paper, the plan exists, right? But in reality, nothing has changed. So when something happens, right, the family is dealing with probate exposure, conflicting instruction, and a structure that was never actually implemented. So this is not a legal failure, this is a coordination failure. So let's talk about the CPA or tax strategist, because this is where most people dramatically underestimate the difference between compliance and strategy. A traditional CPA report what already happened, right? A tax strategist model what should happen, right? That means asking questions the other advisors are not responsible for asking. So which assets should be gifted now, which should be held until death to capture or step up in basis, which assets should be sit in a trust, and which should intentionally stay outside because of future tax consequences. How does a distribution from a trust affect who paid the tax this year? How do we avoid triggering unnecessary gift tax reporting or wasting exemption on poorly structured transfers? So at your level, these are not theoretical questions, right? They directly impact how much wealth your family keeps. And this is where coordination becomes real. An estate attorney might create a bypass trust or a Q-tip structure. The tax strategist has to determine what actually goes into those structures, because funding a trust with the wrong asset can cost more than not having a trust at all. For example, putting highly appreciated asset into the wrong structure can eliminate a future basis adjustment and create a large capital gain problem later. On the other hand, failing to move appreciating assets out of the estate when estate tax exposure exists can create unnecessary transfer tax. There is no single right answer, right? This is only alignment because the structure and the outcome. So now you want to layer and gifting. So most people think gifting is simple, right? Stay under the annual exclusion and you are fine. This is not how this works at a high level. Gift to individual, gift to trust, and gift of business interest all behave differently, right? Present interest versus future interest matter, valuation matters, reporting matters, disclosure matters. If you are transferring interest in a closely held business or real estate entity, the valuation is not just a number, right? It determines how much of your exemption you are using and whether IRS will respect transfer. A weak valuation or sloppy reporting can unwind the entire strategy years later. So the tax strategist and valuation expert has to coordinate. The legal document has to reflect the intended structure, and the reporting has to be consistent with both. Again, the value is not in knowing each piece. The value is in making sure the pieces match. So now let's talk about a trustee or executor, right? Because this is where even well-designed plans often break. A trustee is responsible for actually running a structure. That means managing assets, making distribution, keeping records, and making tax-sensitive decisions throughout the life of the trust. And those decisions matter more than people think, right? Trusts reach high tax rate very quickly. Whether income is distributed or retained, change who pays the tax and how much is paid. The timing of distribution can shift income between years, right? Election can change how income is treated. Administrative delay can create additional tax exposure. This is not passive, this is active financial management inside a legal structure. The same applies after death. The executor is responsible for gathering assets, handling liabilities, making election, coordinating filing, and determine how and when assets are distributed. The estate become its own taxable entity. Decisions made during administration affect both the estate and the beneficiary. If no one is coordinating those decisions with the overall plan, the family ends up paying more tax and dealing with unnecessary complexity. Now add insurance into the picture, right? At a basic level, right? Insurance is protection, right? At a high level, insurance is liquidity strategy. It is used to create cash where the estate is otherwise illiquid. It prevents forced sale of businesses or real estate. It equalizes the inheritance between beneficiaries. It can be structured to sit outside of the taxable estate if designed correctly. But again, only if it is coordinated. If the policy is not aligned with the trust, if the ownership is wrong, the beneficiary designation are inconsistent, or if the funding strategy is not handled properly, then it does not solve the problem it was intended to solve, right? It becomes an expense instead of a tool. So when you step back and look at all of that, you start to see the real issue, right? It's not that clients lack advisor. It is that no one is responsible for the system. The estate attorney is not monitoring tax outcome. The CPA is not redesigning legal structures. The insurance advisor is not coordinating with trust administration. The trustee is executing based on what exists, not with what was intended. The client is left in the middle, assuming everything is aligned. This is where high net worth family get hurt, right? Not from obvious mistakes. It's from invisible gaps. Let me give you a simple example, right? A client have a revocable trust drafted. They believe everything was handled, but no one updates title, no one align beneficiaries, designation, no one model the tax impact of their assets mix. They pass away, so some assets flow through the trust. Some bypass it entirely. Some go through probate, and no one plans for the income tax consequences of liquidating certain positions. The document was correct. The outcome was not, unfortunately, and that is the difference between planning and coordination. So a premium wealth strategy team operates differently. There is a central strategist who acts as a quarterback, right? So that person understands tax, trust, asset protection, and transfer strategy well enough to connect all the moving parts together that ensure that when a trust is drafted, it is funded. When assets are transferred, the tax consequences are modeled. When gifts are made, valuation and reporting are handled correctly. When administration begins, decisions are made intentionally, not reactively, right? They are not replacing the other advisor, they are aligning them. Because the highest value work at this level is not creating ideas, it's in making sure nothing falls through the cracks between those ideas. And once you understand that, you started to see why some family preserve well across generations, why the others slowly lose control, even with good advisors. In the next video, we are going to move from understanding the team to designing the system. Because once you know who should be involved, the next question is how to build a structure that keeps wealth protected, tax aware, and controlled over time. High-level clients do not wait for crisis. They run an annual review before the crisis. And if your client household is in that roughly $2 million to $25 million range of assets, the annual review cannot look like a tax organizer meeting with nicer language. It has to feel like a private wealth strategy session. Because at that level, the real risk is actually not one bad investment. The real risk is drip. Drip in entity structure, drip in title, drip in beneficiary, drip in basis, drip in concentration, drip in family circumstances, and drip in exit readiness. So this is what video is all about, right? This is the annual wealth review for serious clients.
should run every year if they want to protect what they build, reduce avoidable tax friction, and keep options open before life, health, or liquidity event make the decision for them. So let's start with the big idea, right? Certificate annual review is not a net worth review. Net worth is too blunt. So two households can each be worth $1 million and have completely different planning realities. One might hold low basis real estate, concentrated stock, or outdated beneficiary designation. The other might have clean trust funding, diversified exposure, better basic positioning, and portability reserve form of first file estate. Those are not cosmetic differences, right? Those are outcome differences. For many affluent households, beneficiary basis, beneficiary designation, and transfer structure matter as much as, and often more than, the headline net worth number. The IRS generally treat inherited property as received at fair market value, based at that. This is exactly why unrealized gain analysis belong in the annual review, not just in the final estate return. So the annual review, I want you to think, have 5 layers, not just 3, right? So first, income architecture. Second, ownership and control. Third, basic and embedded gain. Fourth, transfer and beneficiary design. Fifth, exit and liquidity readiness. So this is the level that affluent client would expect, right? So let's start with income architecture. Most advisors review income like historians, right? Certificate advisor review income like strategists. That means you do not merely ask what the client earned last year. You ask what kind of income are compounding inside the household, where they are lending, how exposed they are to ordinary taxes, tax rate versus capital gain treatment, and whether the structure still matches the economics. If a founder household has a W-2 income, K1 income, rental income, portfolio income, and deferred compensation or equity compensation, the annual review should separate those streams and force decisions around them. So which income is controllable? Which income is recurring? Which income is concentrated? Which income is exposed to a near-term liquidity event? Which income should be accelerated, deferred, harvested, offset, or shifted by entity, trust, or family planning? This is a different conversation from how did last year go. And it's matter, right? Because tax law is applied for a category, not just totals. If a client have appreciated security and charitable intent, donating long-term appreciated security can eliminate the capital gain tax on the donated position, while potentially preserving a charitable deduction. If the client is heavily concentrated in employer stocks inside retirement plan, net unrealized appreciation may, in the right fact pattern, convert part of what would otherwise be ordinary income treatment into capital gain treatment, right? Those are not niche ideas for the ultra wealthy family, right? Those are exactly the kind of annual review decision that separate passive affluent from active wealth stewardship, right? So this is also the point where you review entity fit, not because entity are exciting, but because stale entity cost money. A client who had the right entity 3 years ago might have the wrong one now because margin change, headcount changes, assets mix changes, state footprint changes on a side venture become material, right? The annual review should ask whether the current entity still create the right mix of liability separation, administrative burden, compensation planning, and tax efficiency. A serious client do not want entity for sure, but they also should not be running an operating business, appreciating real estate and family investment assets through a structure that no longer matches risk or purpose. Second is ownership and control. This is where many affluent households discover that their legal plan and their real-world ownership map are not the same thing. Every year, major assets should be reviewed through one simple lens. Who owns it, who controls it, and what happened to it if something goes wrong tomorrow. That means reviewing individual title, LLC membership interest, trust ownership, TOD and POD designation, life insurance ownership, retirement account beneficiary, and any mismatch between what the documents say and what the account or deed actually show. Because in real life, the title usually wins first. The beneficiary designation are especially dangerous because clients assume their will or trust control everything. Often it does not, right? Beneficiary designation on retirement account, life insurance, annuity, and similar account can override the rest of the estate plan. This is why they must be reviewed annually, not every 10 years. And at this wealth level, the review should go beyond are the names updated. You also ask whether the ownership structure is still accomplishing the client's real goal. Is it assets supposed to avoid probate? Is it supposed to be shielded from a child divorce risk? Is it supposed to stay inside a bloodline? Is it supposed to be available for a surviving spouse but ultimately protected for children from a first marriage? Is it supposed to be outside the taxable estate or intentionally inside it to obtain basis recess? So those are not just drafting questions, right? Those are annual review questions. Third point I want to talk about to you today, basic and embedded gain. So this is where the annual review gets much more sophisticated and much more valuable. Affluent clients do not just own assets, they own tax history. A serious annual review should indicate a basic map, not a vague awareness that some assets are appreciated, an actual ranking of the household major assets by basis quality. Which assets are low basis and highly appreciated? Thus, you want to know. Which assets have suspended passive losses? Which assets have major depreciation recapture exposure? Which assets are good hold onto that candidates because the potential basis adjustment? Which assets are strong sale candidate because basis is already high, right? Which assets are poor gift candidates because gifting would carry over low basis instead of resetting it. This matters because for many households under the federal estate tax threshold, the biggest tax exposure is no longer transfer tax. It is capital gain tax and recapture. And after July 2025 tax law change, the federal basic exclusion amount have increased over $15 million for 2026. Index thereafter, right, which makes basic management even more central for a large portion of affluent households who may not owe estate tax but still have significant unrealized gain exposure. This is also why the annual review should identify assets that should not be casually gifted, right? A client might want to start giving things away, but if they give a low basic asset during life, the donee generally receive carryover basis, right? So that might solve one problem and create another problem, even bigger problem maybe, right? So in contrast, some assets are better retained if the family expects a basis adjustment at death. The annual review is where you decide which asset belong to which bucket, and this is where more advanced planning starts to appear. If the client is charity inclined and sitting on concentrated appreciated stock, you do not always start with sell and give cash. Sometimes the better annual review question is whether to donate appreciated security directly, use a donor advised fund, or in the right case, consider a charitable remainder trust as a way to diversify without immediate recognition of the donor level while creating income stream and charitable remainder. So this is the difference between a generic review and an affluent client review, right? 4 is transfer and beneficiary design. So this is where family events become planning events. A new grandchild is not just good news, it is a trigger. A second marriage is not just a personal development, it is a trigger. An adult child getting divorced is not just family drama, it's a trigger, right? A parent beginning to decline is not just a caregiving issue, it's also a trigger. A child joining the business is not just a staffing issue, it's also a trigger. The annual review exists to catch the trigger with options still exist. At a minimum, this layer should review current beneficiary, successor fiduciary, power attorney, healthcare directive, or trust term for children, and whether the current transfer plan still reflects the family the client actually has, not the family they had when the document was signed. For retirement account, this gets even more important, right? Many inherit retirement accounts are now subject to the 10-year distribution framework after death, but narrow exception for eligible designated beneficiary such as surviving spouse or minor children until majority, certain disabled or chronically ill beneficiary, or a person not more than 10 years younger than the owner. That means beneficiary design is not just about who received the asset, it's also about how quickly the tax burden may be forced out. This is also where you review portability and use it or lose it planning. If the spouse has died, was portability properly preserved? If the executor did not timely file the Form 706 when required for portability, the surviving spouse might lose access to the deceased spousal unused exclusion that could matter later. Even when a household is not clearly above the estate tax threshold today, that review can become critical after business growth, a liquidity event, or legislative change. And for a living client, the gifting review should be run like a calendar, not an impulse, right? Who is receiving annual exclusion gift, right? A gift be made outright or in trust? Are the gifts funding future appreciation transfer or just moving cash randomly? Is there a reason to use valuation work for closely held interest? Is the documentation strong enough if the IRS ever asks what was transferred and how it was valued? The last point matters more than many advisors admit, right? The IRS gift tax framework and reporting rules make valuation and adequate disclosure essential when transfers involve entity, trust, or discounted interest. Fifth, exit and liquidity readiness. Right? This is a category many wealthy households ignore until the deal is already on the table, and that is too late. If the client owns a company, a major block of private stock, or a heavily appreciated real estate portfolio, a concentrated public stock position, the annual review should ask one question very directly. If liquidity shows up in the next 12 to 36 months, are we structurally ready? Because exit planning is not a transition memo, right? It is a multi-year discipline. Before a founder sells, you want to know whether trusts are already in place, whether a family transfer planning has already happened, whether there is a charitable strategy for low basis share, whether the ownership records are clean, whether valuation support exists, and whether the client personal objectives are clear. So PwC, for example, notes that private company exit planning is driven not only by valuation and liquidity, but also by tax estate planning and succession and stakeholder concern. Right? This is exactly why it belongs to the annual wealth review and not only in the sale process. And for some founder household, you should also be asking whether there is a special opportunity that deserves a separate workstream. Does the C corporation qualify for a qualified small business stock review? Is there concentrated employer stock that make a net unrealized appreciation analysis worthwhile? Is there an older, low basic real estate asset that should be evaluated for whole refinance, exchange, charitable planning, or eventual step-up strategy. Is the charitable vehicle appropriate before a sale rather than after the wire hits, right? A premium review does not force all those ideas. It raises them before the window closes. Now let me give you the kind of mini case that makes this real, right? Let's say the client household has a profitable business year, buy a new rental, welcome a new grandchild, and realize that one parent is now clearly entering a period of decline. The generic advisor say, congratulations, update the tax projection, right? And maybe ask about insurance. A serious wealth advisor sees 4 separate planning workstreams. A profitable business year means income and architecture have changed. Compensation, estimated tax, charitable timing, retirement planning, and possibly entity strategy all need to be revisited, right? A new rental means the ownership map has changed, like title, liability segregation, beneficiary structure, trust alignment, and basis tracking all need attention from day one, not after a claim or a death. A new grandchild means the transfer plan have changed, right? Annual gifting, trust design, education, funding, multi-generational planning should be all reviewed while the household is healthy and coordinated, right? The aging parents mean incapacity, liquidity, caregiver dynamics, and protective planning are now active issues. That may mean updating power of attorney, retiring assets, reviewing elder vulnerability, and separating assets that should not be exposed to later chaos, right? That is what serious clients pay for. They pay for someone to see the pattern before the family feels the pain. And that brings me to the last point, right? The annual review is not only good for the client, it's the core recurring advisory model for the firm. Because once you move beyond tax preparation, you need a disciplined reason to sit down every year and review the household like an integrated enterprise. Not just taxes, not just investment, not just document, not just insurance, not just trust. The whole household, right? The annual review becomes the meeting where you update the balance sheet, map unrealized gain, review entity fit, verify title beneficiary, review family changes, identify gifting opportunity, and pressure test the exit plan. This is the work that high income and high net worth clients actually respect. They do not want a pretty organizer, right? They want synergy, right? They want prioritization. They want someone who can say, here are the 3 decisions that matter this year. This is what happened if you did nothing, and this is how we sequence the next 12 months. This is how the annual review start being generic and start feeling indispensable. And that is the transaction into our next video in the series, because once you understand what the annual wealth review should cover, right? The next question is obvious, right? Who should own each part of the process? How do the CPA or tax strategist, how do the estate attorney, financial advisor, insurance professional, and valuation expert work together, and how to keep the client from falling into the crack between advisors? So join me for our next video. How to read your own identity chart like a family office. So most wealthy owners do not actually understand their own structure until something goes wrong. They think they do because they know the names of their LLCs, they know there's a revocable trust somewhere, they know the operating business is an S corporation, they know the rentals sit in entities, they know the retirement accounts have beneficiaries. But that is not the same as understanding the structure, right? So a family office does not look at your word as a pile of documents. It looks at your word as an integrated control system. It wants to know who legally owns the assets, who is taxed on the assets, who controls the asset, who inherits the asset, and what happens if the key person becomes disabled, die, get sued, or sell. So that is the level we are going to work at in this video, right? So if you have a network in the $2 million, right, to say $25 million range, this is where wealth planning starts to separate from basis estate planning, right? So at this level, your problem is usually not whether you have documents. Your problem is whether your ownership architecture actually matches your tax strategy, right? Your protection strategy and your transfer strategy. So here's the first upgrade for you. Do not just build one chart, right? You want to build 3 layers into one chart. The first layer is legal ownership. Who holds title? The second layer is tax ownership. Who reports the income, gain, loss, and basis consequences, right? The third layer is control. Who can move money, sign documents, refinance, and then distribute, sell or vote, or replace the person who can't. If your current entity chart only show entity name and arrows, it's not a planning chart, it's a decoration, right? That's matter, right? Because legal ownership and tax ownership are often not the same thing. A revocable trust is commonly treated as a grantor trust, which means the trust might hold the title while the grantor is still treated as owning the income tax consequences directly. The IRS instruction for Form 1041 states that a revocable trust is treated as a grantor trust, and that in general a grantor trust is ignored for income tax purposes, right? With the income and distribution treated as belonging directly to the grantor. The same thing happened with single-member LLC. Many wealthy owners assume each LLC is a separate tax silo. Often it is not. The IRS say a domestic single-member LLC is generally treated as a disregarded from its owner for income tax purposes unless it elects corporate treatment. While a domestic LLC with 2 or more members is generally classified as partnership unless it elects otherwise, like S Corp or C Corp, right? So the first certificate move is this. Your chart must distinguish legal boxes from tax boxes. Now let me show you how a family office style chart is actually read. So at the very top, put the household, right? Not the entity, the household. So let's use a hypothetical client family. We'll call them Michelle and Elena. Their net worth is roughly $14 million. So Michael owns a profitable S corporation, consulting and operating business. Elena owns about 20% interest in a family real estate partnership she inherited years ago. Together, they own a primary residence, 3 rental property, a taxable brokerage account, retirement accounts, a revocable trust, and a newly created irrevocable trust for the children. They have 2 adult children, 1 financially strong and 1 still immature. On paper, they are well planned. In reality, they are exactly the kind of family where structured drip happen quietly. So let's start with personal assets, right? The family office question is not just what do they own personally, right? The better question is which assets are still personally exposed, personally taxed, or personally bottlenecked. So on the chart, you want to list the resident, brokerage, cash retirement account, life insurance, any personally held notes or partnership interests, right? Then right next to each asset, the title, the tax owner, the appropriate fair market value, the estimated basis, the transfer mechanism, and the control person. The basis column is where certificate planning begins, right? IRS Publication 551 say basis is your investment in property for tax purposes and is what you use to determine gain or loss on sale, depreciation, and other tax consequences. It's also emphasized that accurate records must be kept for all items that affect basis. Why does that matter? for an entity charge, right? Because high net worth family do not lose wealth only from income taxes. They lose wealth from selling the wrong asset at the wrong time with the wrong basis profile. If Michael has one rental property worth $2 million in a very low adjusted basis, and another worth $2 million with as much higher basis, those are not economically identical assets, right? Even if the market value is the same, your charge should force that difference into view. Then move to business assets, right? Michael operating business is an S corporation. It's good, right? But that does not tell you enough. The IRS explained that S corporation has income losses deduction and credit through to shareholder, and that shareholder report the flow-through item on their individual return. So, on the charge, do not stop at Michael owns 100% of S corporation. Add a second line underneath it that say K1s go to Michael. Add a third line that say stock basis tracked by Michael, not by the corporation. That is critical because the IRS is explicit that the shareholder, not the corporation, is responsible for tracking S corporation stock and debt basis, and that the taxability and distribution and the deductibility of losses depends on that basis. This is where boring entity charge become strategic, right? If your charge does not show where the K1 lands, where basis is tracked, and where distribution are actually going, then you are not looking at a wealth map. You are looking at a legal org chart with the tax story missing. So now let's ask the rental, right? So Michael and Elena have 3 rental properties, right? One sit in a single family LLC owned by Michael. One sit in a single member LLC owned by the revocable trust. One is still in their personal name, right? But the refinance paperwork are never cleaned up after closing. That one page already tells an advisor a lot of information. The first rental might give liability segregation, but from an income tax standpoint, it might still be disregarded back to Michael. The second may be title to the trust, but if the trust is revocable, the income tax result might still flow back to the grantors. The third is fully exposed because the liability strategy and tiling strategy was never completed. Again, the IRS default classification rules for LLC and the grantor trust rule make clear why the legal owner and tax owner can diverge. Now let's overlay the trust layer, right? Because this is where affluent family usually think they are more organized than they are. So Michael and Elena has a revocable trust. Fine, right? But the family office question is not, do you have a trust? The real question is, what does the trust actually own? What does it not own, and what still passes outside it, right? The IRS Internal Revenue Manual say that assets with beneficiary designations such as retirement account, life insurance policy, and payable on that account are not controlled by a will, and that beneficiary designation takes precedence over the will. That means your map have to show not just trust ownership, but also beneficiary-driven transfers. In Michael and Elena case, the revocable trust might own the house and the taxable brokerage account, but the IRA might name each other individually, and the life insurance might still point to an outdated trust or to their estate. This is exactly the kind of mismatch that certificate family pay for later through delay, taxation, litigation risk, or wrong person outcome. This is why your chart needs a transfer column, right? For each asset, whether it passes by title, beneficiary designation, operating agreement, trust instrument, buy-sell agreement, or probate. If you do not know the answer, that is not a small detail. So this is the point of the exercise. Now let's move up another level, right? A family office chart also tracks successor control. Who steps in, right, if Michael is alive but incapacitated? Who votes the S corporation share? Who signs for the LLC? Who can refinance property? Who replaces the trustee of the irrevocable trust? Who controls distribution for the children? Who have actual authority versus assumed authority, right? This is where family discover that the named successor trustee is not the same as the person capable of managing a business, a real estate portfolio, or a complex tax posture. A trust document might solve one problem while leaving an operating business leadership problem untouched. And here is where the trust becomes powerful, right? It reduces concentration risk. If Michael is the shareholder, manager, signer, tax point person, relationship owner with the bank, and practical decision maker on every asset, then the household is not diversified from a control standpoint, even if it looks diverse from an investment standpoint, right? So this is a family observation. It's not retail observation. So now let's take the case one step further and make it more advanced, make it more interesting. Suppose Elena inherited partnership interests have a major building gain. Suppose the brokerage account had appreciated concentrated stocks. Suppose one rental had large suspended passive losses. Suppose the primary resident has substantial appreciation but is still in a clean personal ownership position. Now your entity charge become a tax triage tool, right? You can start asking higher level questions, right? Which asset a strong candidate for a basic step up strategy, right? The IRS states that inherited property generally get a basis equal to fair market value or at death, subject to certain estate tax valuation rules and consistent requirements. Which asset should not be gifted away casually because you should be exporting future step-up potential? Which entity need cleanup before a sale process begins? Which entity's designation need to be conformed before a death or incapacity event expose the mismatch? Which trust-owned assets should stay where they are, and which should be retitled because the current structure solves one issue while creating two other issues, right? So many layers to understand and solve, right? And which assets are supposedly in the trust but are recently just listed on a schedule nobody updated, right? This is how certificate advisor read a chart, not just static ownership, right? But as future tax consequences, future control right, and future transfer friction, right? This is one more advanced point that I want you to understand. For affluent household with revocable trust, the map should also include the post-death tax administration path, right? The IRS states that a qualified revocable trust and the executor of the related estate can make a Section 645 election, so the trust is treated and taxed as part of the related estate during the election period. Why do I care about that in an entity chart, right? Because high-end planning is not just about where the assets sit during life, it's also about how administration works after death. If the map never showed the hands-off from living structure to estate administration structure, then the family is only planned for the easy years, not the expensive years. So here's the assignment that I want you to take from this video. You want to create your own family office style map, right? You want to put yourself and your spouse at the top, right, in the household name. Under each asset and entity, you want to show 5 things. Legal owner, tax owner, control owner, transfer mechanism, and basic note, right? Then add one more notation in red. What breaks if the primary decision maker disappears for 90 days? That is the test. If one person absent creates chaos, your structure may be asset rich but system poor. And if your map reveals mismatched beneficiary, designation, basis blindness, untracked as corporation basis, disregarded LLC confusion, or trust funding gaps. Good. That means the map worked because it reveals those weakness that now you track it, you can see it, and then you can fix it. Because most wealthy owners do not actually understand their own structure until something goes wrong. The goal here in this video is to understand the issue right before that happens. So in the next video, we are going to move from reading the structure to repairing it, right? Because once the chart exposes the weak points, the next question is how to clean them up without triggering avoidable tax, transfer mistake, personal name LLC or trust. Where should the asset actually live? The question is not whether you own the assets. The question is what should own it, right? At higher levels of wealth, ownership is not a legal formality. It's a strategic decision that directly affects liability exposure, tax outcome, and how efficiently wealth transfer across generations. If you place an asset in the wrong location, you might not notice the cost immediately, but over time it shows up as unnecessary taxes, legal exposure, administrative friction, and lost optionality. This is where most affluent families underperform, not because they lack assets, but because those assets are not positioned correctly. So the goal here is to give you a framework, not rules, right? A framework for thinking. So every asset you own should be evaluated through 3 lenses at the same time: risk, tax treatment, and transfer strategy. If you only optimize one, you will likely create problems in the other 2. So let's start with the first one, which is risk. Risk is about who can reach the asset if something goes wrong. If you own a rental property in your personal name and there is a lawsuit, the claim is not limited to that property. It can extend to your entire personal balance sheet, right? This is why LLCs exist for in planning, not for tax saving in most cases, but for liability isolation. But here is where more advanced planning starts. The real question is not just whether you have an LLC, it is who owns the LLC, right? Because if you personally own multiple LLC and you pass away or become incapacitated, those interests still have to be transferred, valued, and administered, right? So certificate structure often layers ownership, right? So the LLC hold the assets, for example, the trust hold the LLC. So now you have separation of liability and the continuity of control. So this is the difference between basic and intentional planning. So now let's move to tax, right? Most people misunderstand this part, right? They assume LLC creates tax advantages. So in most cases, they do not. A single member LLC is typically disregarded, right? So the income still flow to your personal return. So if tax does not change, why the structure still matter, right? Because structure affects timing, character, and future flexibility. For example, if you ever want to transfer ownership or get partial interest or reposition asset into a trust, the entity structure gives you control over how that happens. It also affects how clean your reporting is, how losses are tracked, and how your overall financial system holds together. So now we move to transfer strategy, and this is where trust becomes central, right? A revocable trust does not reduce your taxes during your lifetime, but it fundamentally changes how assets move. It eliminates probate. It provides continuity if you are incapacitated. It allows assets to transfer according to coordinated plan instead of a court process. And for affluent families, speed and control at JET are not small benefits, they are essentials. But again, the deeper strategy is not just using a trust, it's deciding which assets belong inside the trust, which should be owned through entities that flow into the trust, and which should remain outside entirely. So now let's apply this to real assets, right? Start with rental real estate. So rental properties carry operational risk, like tenant, contractor, and third party interact with the property. So from a risk standpoint, many rentals belong inside LLCs. But from a transfer standpoint, the LLC itself should often be owned by a revocable trust. So that way, if something happens to you, control of the LLC transition immediately without court involvement. From a tax standpoint, nothing changes day to day, but the long-term flexibility improves significantly. So now let's go one level deeper. Advanced planner. Don't just think about liability, right? They think about basis. If a property has significant appreciation, you have to decide whether that asset is better held for a future basis adjustment at death or transfer during life. If you give that property today, the recipient receives your carryover basis, right? If you hold it until death, the basis is typically adjusted to fair market value, right? This is not a small difference. That can be a 6 or 7-figure tax decision. So now the ownership decision is no longer just about protection, it's about future tax positioning, right? So now let's shift to the primary residence. So this is one of the most commonly misstructured assets. So people hear about LLC and try to apply them everywhere. But your primary residence is different, right? You might have homestead protection, depending on your state. What else you have? You have capital gain exclusion rules when you sell, when it's still your primary home. The lender prefer clean individual ownership. Placing your primary residence into an LLC can create more problems than it solves. So most primary residences either remain in your personal name or are titled in a revocable trust. The trust provides continuity and avoids probate without interfering with tax benefit. This is a very intentional decision. So now let's talk about S corporation ownership. So this is where mistakes become expensive, right? S corporation have very strict ownership rules. Not every trust qualifies to own S corp shares. If you play S corp stocks in the wrong entity or trust, you can terminate the S election. What does that mean? That means you could unintentionally convert a pass-through entity into a C corporation, creating a completely different tax regimen, right? So ownership here is not just about strategy, it's about compliance also. So for most clients, S corp shares are either held individually or played into a properly structured trust that meet the qualification rules. This is where coordination between your CPA and estate planning attorney become very critical. So now let's move to brokerage accounts. The assets typically have low liability risk but high tax sensitivity. So there is no reason to put a brokerage account into an LLC, but there is a strong case for aligning it with your trust. Not for income tax reason during life, but for transfer efficiency and basis planning. If the asset remain in your taxable estate, they may receive a step-up basis at death. That eliminate embedded capital gain. So again, the decision is not just where to hold the assets, it is what outcome you want later. So let's talk about retirement account and life insurance. So they operates under completely different rules. Retirement accounts must remain individually owned, right? You cannot transfer them into an LLC or a standard trust without triggering consequences. So planning here shifts from ownership to beneficiary designations. Who receives the accounts? How quickly must it be distributed? Does the structure create tax acceleration or allow for better control? For life insurance, more advanced planning might involve a irrevocable trust. So not for income tax purposes, but to remove the assets from your taxable estate and control how proceeds are distributed. Again, different assets, different strategy. Now let's bring this together with a case, right? So a family owns a primary residence, a rental condo, and an S corporation. If something is held in their personal name, they are exposed on multiple fronts. So the rental creates liability exposure to the entire balance sheet. The primary residence passes through probate. The S corporation transfer without coordinated control, right? Now we restructure, right? The rental condo is placed into LLC, and that LLC is owned by the family trust. The primary resident is titled in the trust to avoid probate while preserving tax benefits. The S corporation shares are held individually or placed inside a qualified trust structure. Now what have changed? The liability from the rental is contained, right? The transition of assets becomes seamless. The tax treatment is preserved. And most importantly, the system now works together. That is the shift, right? So ownership is not about convenience, it's about alignment. So each asset should sit exactly where it serves your risk profile, your tax strategy, and your long-term transfer goals. When the alignment is missing, wealth will leak, and that is what we're trying to avoid, right? So when alignment is intentional, wealth compound more cleanly and move more efficiently. And once you start thinking this way, you're gonna stop asking, what do I own, right? You wanna start asking, where should this asset live? In the next video, we are going to take this one step further and show how to layer this structure into a coordinated system so everything works together instead of operating in isolation. But remember, everybody's situation is very different. I'm only provide some general educational information that as example of how the asset can be placed together. But do talk to your tax advisor, your tax strategist, and do talk to your estate attorney for this.